today we're talking about investing in individual stocks versus index funds. And if you're watching this video, you've probably heard that the research shows that active stock picking largely does not outperform index fund investing. The most recent stats for the United States shows that 82.51% of actively managed funds underperformed compared to the S&P 500 index. And to add insult to injury, research further shows that even for the funds that do manage to outperform the S&P 500, it's unlikely for them to be able to continue this overperformance, with only 41% of them being able to continue to be within the top half of performing funds. So this basically further reinforces the idea that index fund investing is better than active investing, and suggests that even when a fund does outperform, it is likely that luck is probably a big factor in that accomplishment, considering that the results are often not repeatable. So that's the main argument for index fund investing, and it's pretty compelling. And for some people, this is all the information they need to make the decision. And it would be quite normal to think, like, well, if only 17.5% of professional money managers can outperform the S&P 500, and less than half of those people can actually continue to outperform, then what hope does the individual non-professional investor possibly have to outperform the market? But now let's look at the other side of this. Ted Weschler is an investment manager for Berkshire Hathaway and manages $13 billion of Berkshire's portfolio. And there's a reason why I bring him up, because there's two especially interesting things about Ted. The first is that he grew his Roth IRA personal investment account from $70,000 to $264 million between 1989 and the end of 2018. And this, of course, was a massive outperformance compared to the S&P 500, because over that same period, the S&P 500 increased 1,194%, while Ted Weschler's investment account increased 314,000%. But now for the second thing. Since joining Berkshire Hathaway, where he's now managing $13 billion of Berkshire's portfolio, he has failed to outperform the S&P 500. Interesting, right? So why was it that he was able to massively outperform the S&P 500 before joining, and now that he's joined Berkshire, he can no longer do it? Why? And the answer to this question is also the reason why you shouldn't be so quick to give up on investing in individual stocks yourself, simply because of the statistics that we talked about. The Washington Post did an article on Ted, and when they asked him how he was able to achieve this outperformance in his Roth IRA account, he was quick to point out that everything he invested in to achieve these results were investments that were available to the general public. So in other words, he didn't have any special deals that weren't available to everyone else. Unlike Peter Thiel, who was recently in the spotlight because he grew his Roth IRA account to $5 billion, but he did so by buying PayPal stock for a fraction of a penny per share, but that was a deal that was not available to the general public. He had access to that deal because he was one of the founders of PayPal. But Ted Weschler's investments, however, could have been replicated by anyone. Nonetheless, the reason he stopped beating the S&P 500 once he began to manage the $13 billion for Berkshire was due to the massively increased amount he was now managing. To the Washington Post, he said that for Berkshire, he looks for investments that can absorb a minimum of $500 million without giving Berkshire an ownership interest of more than 10%. This means he must look at companies that have at least a market cap of $5 billion, and possibly even higher than that, because there would still be plenty of $5 billion companies that wouldn't be able to absorb a $500 million investment without having its price affected from all the buying. And when these guys are buying stock, they don't want to push up the price. They want it to stay where it is so they can keep buying at that price. There are currently over 4,000 US public companies right now available to buy and sell. And if you include the stocks that are traded in the over-the-counter markets, that number goes up to over 11,000 companies. Now, only 950 of those companies have a market cap above $5 billion. And half of them have an average daily trade volume value of less than $100 million every day. This means that even if Ted was buying half of all the daily volume, it would take at least 10 days to make a $500 million investment into many of these stocks. And Ted Weschler even said that now that he has joined Berkshire Hathaway, his personal investment accounts get a lot less attention because the stock opportunities that he's looking for at Berkshire are not the same opportunities that he's looking for his personal investment account. And the reason for this is that in his personal investment account, with it being much smaller in size compared to the $13 billion he's managing at Berkshire, he's not restricted to only those largest companies. Now, by the way, guess who else is restricted to only looking at the largest companies? That's right, virtually every single money manager that can't beat the S&P 500. They're in the same boat. The largest companies have a lot of eyes on them, and there is a lot less opportunity for any one of them to become significantly underpriced. Smaller companies, however, have a lot less competition around them and are much more susceptible to becoming mispriced by the market. And that's where the opportunity is, of course. And this is also in line with something that Warren Buffett himself has said. He has said on a few occasions over the years that if he was running a small portfolio, he could easily get 50% annual returns. Here's the exact quote from an interview he did with Bloomberg Businessweek. "If I was running 1 million today, or even 10 million for that matter, I'd be fully invested. Anyone who says that size does not hurt investment performance is selling. The highest rates of return I've ever achieved were in the 1950s. I killed the Dow. You ought to see the numbers. But I was investing peanuts then. It's a huge structural advantage not to have a lot of money. I think I could make you 50% a year on $1 million. No, I know I could. I guarantee that." Now, all of this is to say that even though the headlines say that active stock picking is inferior to index fund investing, I wouldn't just immediately take that at face value and assume that this means you can't do it. Because although this may be true for the big money managers of the world, it's not necessarily equally as true for us smaller investors who don't have the same restrictions and limitations on them in the same way. The main advantage that still remains for low-cost index fund investors is just the fact that it's completely passive. If you're an index fund investor, you can literally set up an automatic monthly contribution arrangement and set your dividends to be reinvested automatically, and then completely forget about it from that point forward. And this is going to be the best way to go for a lot of people because, let's face it, a lot of people are just not that interested in reading financial statements and reading annual reports for dozens or hundreds of different companies and doing the work that's required to analyze a company before buying it. When you're buying index funds, the cost is almost nothing. The Vanguard S&P 500 index fund has an expense ratio of 0.03%. This would mean that for every $10,000 invested, it would cost you $3 per year. And the fact that index funds have such low costs is also one of the main reasons that actively managed funds can't beat them. Because for the most part, actively managed funds underperform the index funds by roughly the amount that they're charging in fees. There is another cost to buying index funds that you don't see, which is an opportunity cost. Because if you're buying index funds, you will never be able to do better than average. You will be doing exactly average. Average, though, is better than below average, but average will never be extraordinary. If you learn how to pick individual stocks, then you do have a chance to make extraordinary returns. Over the past 30 years, the S&P 500, with dividends being reinvested, has achieved an annualized return of about 10.6%. Now, who knows if over the next 30 years this will be repeated, but if it was, and if you were starting with $0 today and just investing $500 every month for those next 30 years, then at the end you'd have $1.1 million to your name. Now that's pretty awesome, especially because it's achievable by almost anyone as long as they have the discipline to spend less than they earn and set up some sort of automatic monthly contribution plan. And by the way, if that's what you want to do, I would just call up Vanguard and tell them that's what you want to do, and they're going to set you up nice. Now there is one other risk with index fund investing that doesn't usually get mentioned, and that's the risk that the historical returns that we've seen over the past 30 years don't get repeated over the next 30 years. Now, by some measures, it's predicted that the stock market as a whole is likely to return negative 3.1% a year from this level of valuation, including dividends. Inflation alone is 4 to 5% per year, which means that your investment returns must be at least 4 to 5% every year just to maintain the purchasing power your money currently has right now. Investing in individual stocks is of course not without its own risks, as you know, and it requires much more time and effort if you're going to be successful at it. Using the same example that we just used, but if we increase the annual rate of return from 10.6% to 15%, we can calculate that the same scenario would have us left with $2.6 million after the 30 years has gone by. And if you're extremely skilled and maybe even a little bit lucky as well and can achieve 20% annual returns, then after those 30 years, you'll have $7 million and you'll have reached the millionaire status around year 20. Now, the other amazing thing about choosing to invest in individual stocks is that once you know what to look for, every few years, you're going to stumble across a ridiculously good opportunity. One that you could buy and could multiply your money by 100x over a 5 to 20 year period. In this book right here, 100 Beggars, which is a personal favorite of mine, their research concluded that there were 365 stocks that you could have bought between 1962 and 2014, a 52 year period, that would have multiplied your money 100 times. And the ones that 100x'd in the least amount of time did it in as little as 4 to 10 years. And when you think about it that way, it means that you're truly one great investment away from retiring decades sooner than you otherwise would have if you were just sticking with the index fund approach. Now, if you want to keep expanding your stock investing knowledge and learn about how to invest money safely, whether that's doing it with individual stocks or through buying index funds, I made this other great video for you right here. So click here or tap here right now to watch that one next, because that's the one that I think you should be watching next. Also, as a quick disclaimer, I'm not your financial advisor. I'm just someone that enjoys helping you learn about stock investing. So I'll see you in the next one.